My name is Buck Chapperton. I'm on board the Concord Coalition. It's my pleasure to welcome you here this morning. 15 minutes ago, we had about 3 people, so we're glad to see you all here. This program is brought to you by several organizations: the Concord Coalition, the Committee for Responsible Federal Budget, the New America Foundation, and the American University School of Public Affairs, and the University Center for Public Finance, and the Tax Foundation. Of course, we're here to talk about bipartisan tax policy, tax reform, and I'll introduce the participants of our panel a little bit later. But let's start off. We're very lucky to have as a keynote speaker Senator Ron Wyden from Oregon. He is a member of the Senate Finance Committee and a true champion of bipartisan tax policy efforts and budget efforts, and it's certainly our pleasure to have him. Senator doesn't know this, but I've never met him before, but I'm on a board of a company in Portland, Oregon, Standard Insurance Company, Standard Financial Group, and I was there on Monday. We had a board meeting, and so I caught up on you a little bit, and you were highly regarded by the board and management of Standard Insurance Company, and I'm sure that's through that. So it's my pleasure to introduce you.
Thanks. Thank you. Thank you for that inflationary introduction. And I think it'd be cruel and unusual punishment to give you a filibuster at 9 o'clock in the morning. I'm not going to torture you with anything like that. I think you've got a terrific program, and the paper is superb. And I thought I'd take a couple of minutes and sort of try to give you a view from the Finance Committee, and also kind of colored by my judgments about where we are in this debate. I think everybody understands that the tax code is going to melt down next year unless there is corrective action in the Congress. But I think it is particularly important for reformers to note right now that there is, I think, a teachable moment and a special opportunity for the reformers, and I want to state it very bluntly. When the new Secretary of the Treasury tells the Senate Finance Committee that with the help of TurboTax, he couldn't get his taxes right, the system cries out for simplicity. And I would offer up that the centerpiece of bipartisan tax reform ought to be to simplify this code. And I want to give special credit to the authors who, throughout their report, come back to this theme. Practically on every page, they talk about the value of transparency and openness. And I really do feel that you should go back and look at the transcript and, if possible, the tape, because it's clear the Secretary was very candid and very straightforward and essentially told the country in an open session, with the help of TurboTax, he couldn't get his taxes right. And it, in my view, is something, again, that brings together the parties. In my legislation that I'm going to touch on, the fair flat tax, our tax form, be able to do it on a computer screen, piece of paper, however you want to do it, is 30 lines long. Mr. Carroll and others work closely with the President's Commission. Their tax reform proposal on the simplicity issue called for a form that was 34 lines long. For purposes of government work, that's pretty darn close. There shouldn't be any problem bringing together Democrats and Republicans for a simplicity agenda. And I think as I get out around the country and talk about this, spoke at the Cleveland Economic Club on this issue, I find that the American people are as hungry to simplify the tax code as they are to even get to the discussion about rates and various other kinds of principles. So when we talk about bringing people together, being able to forge bipartisan policy, point number one goes to the fine paper of the authors that focuses on the value of transparency and simplicity. I also want to go to a couple of the other kinds of key points that I think the authors have touched on that also bring together Democrats and Republicans. Right at the heart of the author's proposal is the concept of broadening the tax base and holding down rates. That, of course, was the philosophy in 1986 when Bill Bradley, I went to school on a basketball scholarship. My jump shot isn't quite as good as Senator Bradley's, but I'm a tall Democrat on the Senate Finance Committee. I want to work with colleagues on both sides of the aisle to do what was done in 1986, what Bob and all of the authors have pulled together for purposes of their report. You ought to move in, broaden the base, and do it by cleaning out a lot of the clutter. The authors in their paper note that the 200 tax breaks listed in the federal budget cost close to $1 trillion a year in lost revenue, that those tax breaks have shrunk the size of the tax base by close to 45%, and that repealing those breaks would allow a 34% across-the-board cut in tax rates. So if you start with bipartisan principle number one, simplicity, then move to the second principle, number two, in my view, which is to broaden the base and lower the rates, you take the report that's being issued and you start weaving your way through to Democrats and Republicans coming together in terms of tax reform. I also want to use the opportunity when we talk about these various breaks to say that my view is that the Congress will probably start reforming the tax code by changing the tax rules as it relates to health care. This is, of course, the biggest single item as it relates to health care spending. In my Healthy Americans Act legislation, which is the first bipartisan proposal to cover all Americans in the history of the United States Senate, going back 60 years, there has never been a piece of legislation that brings together Democrats and Republicans to cover everyone. The centerpiece of that is reforming federal health care tax rules. These rules go back to the 1940s when there were wage and price controls. There wasn't any way to get health care to people. And of course, back then, the economy was built around the idea that somebody would go to work when they were 19 and stay put for 30 years until you gave them a gold watch and a big steak dinner and wished them well in retirement. The typical worker today changes their job 11 times by the time they're 40. So my view is that on the tax reform agenda, particularly as it relates to the key recommendation of the authors, the tax reform agenda does start with respect to health care. You cannot hold costs down unless you change the incentives that drive the behavior in American health care. And nothing does that more profoundly than the tax code, which encourages inefficiency and rewards disproportionately the most affluent. It's gotten to the point in our country where if you're well off and you want to go out and get a designer smile put on your face, you can do it and write the cost of your designer smile off on your federal taxes. And if you're a hardworking woman who works at a local furniture store and your furniture store doesn't have a company plan, not only do you get nothing, you subsidize Mr. Designer Smile on his particular benefit. I'm all for people buying whatever they want. Go buy 5, 6 designer smiles if you want, but not with the taxpayers' money. So as it relates to point number 2, in terms of broadening the base, lowering the rates, and particularly the author's recommendations as it relates to health care, that ought to be at the centerpiece. And by the way, there is so much money in that particular tax break that in our legislation it is possible to give a middle-class family, a husband, a wife, and 2 children, a $17,000 tax deduction for purposes of buying health care. That's how much money is in this break if you reform it so as to not reward disproportionately the most affluent and encourage inefficiency. Now, the average American, by the way, a typical family of four last year spent $12,600 on their health care. So in the Healthy Americans Act, if you reform federal health rules and you give the typical family of four a $17,000 deduction, most people are going to end up getting a tax cut. Let me tick through just a couple of other recommendations from the authors, and Buck, I don't know what your pleasure is, if you want me to take questions or whatever's your pleasure. But third, I think the report makes a very important judgment in terms of saying that you have to, in tax reform, reduce the economic distortions caused by taxes. It's very obvious that the tax code contributes to a playing field that rewards trying more to find the latest loophole and the latest interpretation of a particular loophole than it does trying to make the products and come up with those economic innovations that are going to most reward risk takers and improve economic efficiency. And I very much appreciate the recommendation with respect to the need to reduce the distortions that come about through the tax code. Finally, the report stresses the value of national savings. What we try to do in the fair flat tax is basically say there are a handful of incentives in the tax code. In those 30 lines in the fair flat tax, which Money Magazine, those experts went and filled out their taxes in 30 minutes under our fair flat tax, we keep all of the current savings incentives as it relates, for example, to retirement or insurance purchases by a middle-class individual. And my sense is, as part of this discussion of tax reform, given this country's low national savings rate, which the report points out, I think that keeping the current incentives is a must. We ought to be looking for ways to expand the incentives. I've long favored those kinds of approaches with respect to saving for retirement that in effect make it automatic that people are going to participate in retirement programs, and in effect they have to opt out of them in order to not participate. But I think the Finance Committee in our country will have a real debate about additional savings incentives. Finally, the report touches on progressivity. We call it the fair flat tax for a reason. And that is, fair means that you respect the need for progressivity, and the flat goes to the other recommendations we're talking about. Simplifying the code, moving away from distortion, promoting provisions, and the like. But I think you accompany fair and flat, and again you move towards the recommendations of the authors, which are that you've got to keep progressivity. We've all heard Warren Buffett's story many times when he talks about how something's out of whack when he's paying a higher tax rate than his secretary. So fairness is going to be important to the American people, but I think you link it to the other recommendations of the report and the ideas we try to incorporate in the fair flat tax that are essential. I close with one last judgment. Bill Bradley told me one day when I called him, and I sort of had a long face, and I was telling him, oh my goodness, I've got this bill, and I sit there in the Senate Finance Committee, and I ask all of the experts who come before the committee, do they agree with the basic principles in 1986? And I've asked 20 witnesses in the Senate Finance Committee if they agree with these basic principles that we're talking about in 1986 in general direction of the fair flat tax. And 19 and a half out of the 20 witnesses told me they agreed with me. And my staff said I ought to give up on the 20th because I had kind of pummeled them until it became half. But the point is The country does, I think, subscribe to the principles in this report. They subscribe to the basic ideas in the fair flat tax. But everybody's pretty skeptical about whether or not anything can really happen. So one day when I was really kind of skeptical about how I was going to move all this forward, and it takes a lot for me to get to that point, because I bring new meaning to the glass half full concept in terms of being optimistic. Bill Bradley said fairly high decibel tones to me, and Bill Bradley doesn't do that very often. He says, just remember, tax reform is always absolutely and completely impossible until 15 minutes before you do it. And I think that's right. I think that is the guiding principle. Everybody says can't be done. The American people are so skeptical of anything involving taxes, and they don't want to hear a lot of baloney that sounds too good to be true. But I think the basic principles that were laid out in 1986 that are in this report of simplifying the code, broadening the base, cleaning out the clutter, keeping progressivity, they were sound more than 20 years ago. They are sound today. So I want to commend the authors. This is a bipartisan effort, and the fact is that people with good hearts and sharp minds have an opportunity to do this. And as soon as I saw Secretary Geithner in the Senate Finance Committee talking about TurboTax and all his frustrations, I said there is a chance this time to approach it differently, come out of the box and say there is no reason why so many Americans should go through water torture trying to pay their taxes, filling out all these forms, spending the time between now and April 15th through the tax code that they'd rather spend with their family. I think this time there's a chance to thread the tax reform needle. Thanks for having me. Softball questions, especially welcome. Yes.
Thanks. I'm Bruce Hahn with the American Homeowners Grassroots Alliance. Thank you so much for all you're doing to simplify the taxes and lead to universal health care. Question of the moment, considering the events of this week, the stimulus package passing. There's increasing background noise that it may not be enough. We may need to get a bigger vote. What are your thoughts? Will there be a need for a second stimulus package? And how will that impact the prospects, or maybe even serve as a mechanism for simplification of
I'm pretty old-fashioned about this. I mean, my sense is if you put a buck out there for investment, you want to see $1.08 or $1.10 or $1.12 in return. And that's kind of how I approach it. This is an investment in a recovery strategy. Now, obviously, that is not precisely how, after the sausage making and the Congress gets done, that happens. But I think that the challenge now is to particularly zero in on the ways to increase investor and consumer confidence. That's what it really comes down to. You know, when you sit on the Finance Committee, all of the best economic experts like Buck and Bob Carroll and others, they all come before our committee, and we have great debates about the philosophy of taxes. We talk about supply side economics and Keynesian economics and lots of discussion about marginal rates. I happen to be one who thinks that marginal rates are a big deal. We should try to hold them down. But we have all these debates about economic theory. And at the end of the day, it comes down to whether the person on the street thinks things are going to get better. And if the person on the street thinks things are going to get better, then they do get better. Now, there are a number of provisions in here that I particularly like. I like the infrastructure, provisions. I think those, make sense. I'm one of the few Democrats who thought we ought to have the alternative minimum tax provision in there, because that's a crushing tax for middle class, people, and I'm concerned about how that fits into the tax reform agenda. So there are parts of this legislation that I think are going to help increase investor and consumer confidence. I'm going to do everything I can to try to help them sink in the body politic and in the marketplace, and then we'll come back and look at where to go from here. It's one of the reasons why bipartisan health reform is so important, is if we can show the country that we can come together on the premier aspect of our economy, healthcare, which is gobbling up everything in sight and faces this demographic tsunami, that would be a huge, huge confidence builder in terms of the economy, and it is there for the doing. There is a philosophical truth, especially in the United States Senate, on healthcare, and I'll just give it to you in a sentence. After all these years of bickering between Democrats and Republicans, we've reached, I think, some philosophical common ground, and it's this. Democrats are right on the idea that to fix this, you got to cover everybody. You got to cover everybody for the essentials, not some Cadillac package. But if you don't cover everybody, the people who are uninsured shift their bills to the insured, and they shift the most expensive bills. So the Democrats have been right on something they care a lot about. Republicans have been right on something they care very much about, which is you shouldn't hand health care over to the government. It shouldn't be one size fits all, run from Washington, federal-dominated health care. You need private choices. You can't discourage innovation. You need to make sure that there's an opportunity for marketplace forces. So Democrats have given, Republicans have given. That's a chance to deal with a major economic question. It will be, according to Chairman Baucus, the next issue we go to after this stimulus legislation. You ought to look at his white paper on health care, which I think is quite a big contribution to this. So we've got some bipartisan support. The Senate Finance Committee is fast out of the gate. If we can get the provisions in the stimulus that really will enhance investor and consumer confidence, and then go on to what I think is the dominant issue given demographics of our time, which is containing health costs and fixing the health system, then I think we're headed in the right direction in the economy, and we won't face the need to have stimulus 3 and 4 and 5 and on. I might take one more and out the door. Yeah.
Thank you for your leadership on tax reform. I'm Kurt Couchman with the Cato Institute.
Right.
And I wanted to see what your thoughts were on replacing our antiquated and inefficient system for regulating pollution with command and control policies, and replacing that with an emissions fee sort of system, and then reducing other taxes with those revenues.
Well, first, without turning this into a bouquet tossing contest, let me thank the Cato folks for all you've done over the years on the tax reform agenda. Good op-ed piece in the paper the other day, and we appreciate it. I'm open to a variety of approaches as it relates to the environmental challenges with respect to the tax code. I want us to recognize, however, that if we're trying to broaden the base and stay away from resolving a lot of society's big challenges through the tax code, we've got to be careful. I think where Cato and others want to go is very sensible, which is towards a more market-driven kind of system. What I want to do in working with all of you and looking at this in a bipartisan kind of fashion is not get to the point where we add another 800 pages to the tax code, a gazillion new rules, and we have sent people back off into tax migraine land because we decided that we were going to use the tax code to address the environmental challenges. Right on the marketplace, right to look for opportunities through the private sector. I just caution that we don't want to get through this effort back into the very places that Cato and others have, to their credit, blown the whistle on, which is a vast new kind of code. More than anything, I wanted to come today to tell you our doors are open to you. We're spending a lot of time trying to work through the kind of key questions, starting with the path of simplicity and broadening the base. Big shout out for our authors. The fact that they delivered this paper at a key time is especially important. John O'Neill is here from our office, our tax man. Good ideas are especially welcome. The old days we used to say call, collect, which is get us your emails, and we'll look forward to working with you. Thank you.
Thank you very much, Senator. I wanted to make just a couple of opening remarks, and then I'll introduce our panel very briefly. And one thing I wanted to say at the outset was the tax system has got a lot of problems. I think I'll dispense with those remarks. I think the Senator has covered that ground pretty thoroughly. But among its other failings, it doesn't raise enough revenue, and we are looking at deficits certainly going forward that are very serious. And the question is whether we can impose the burden of raising additional revenues at some point in the future. And if we are, we better get a system that can do it well. I do think, in looking back on when we've had similar situations, I'm glad the Senator pointed to the 1986 Act, because I wanted to mention that as well. When Reagan came to town in 1981, tax rates were very high, 70% for individuals and 46% for corporations. I was Assistant Secretary for Tax Policy at that time, and it was a very interesting time. He proposed a serious cut across the board on taxes, proposed 35%, got 25% in tax rates across the board, immediately dropped the top rate on individuals to 50%, and left the rate on corporations at 46%, but gave the corporate community a huge cost recovery benefits, accelerated depreciation, and investment tax credit. That was the whole theme during the first Reagan term. In his second term, he switched course pretty dramatically, and after a long study, produced what became, well, he produced it in December of in his State of the Union, in December of '84, what later became the Tax Reform Act of 1986. And in that act that the Senator referred to, it was major base broadening, major lowering of tax rates. The individual top rate was dropped to 28%, corporate rate to 34%. You think very costly, you think, and how do you think it was paid for? It was revenue neutral. It was paid for by withdrawing the accelerated depreciation and investment tax credits from the corporate community. And yet the corporate community supported the '86 Act. I'm sure some of you remember that. And a lot of people think that what that means, if you give low enough, if you give enough tax benefits to the individuals, that is the CEOs, drop their tax rate to 28%, you can buy a lot of support at the corporate level. The stated intent was to remove tax considerations from business and financial planning. And we think about just business and capital to project all real economic income to the same tax treatment. And in my view, that was largely achieved. Capital gains were taxed as ordinary income, great simplification of the tax code. Indexing of basis was put in the law, which is certainly not simplification. And the tax sheltering, which had become a serious problem in the 70s, was seriously curtailed, primarily by just taking away the benefits for the tax benefits for particular types of investments. I think the code was made considerably simpler, and obviously the Senator agrees, in the sense that the opportunities for avoiding taxes were seriously diminished, and advisors, there simply weren't many places to go for making investments that reduced your tax benefits. I might say parenthetically, in my view, it's probably what gave rise to the new form of tax shelter we saw in the 90s, where people invented derivative-based tax shelters with little or no investment motive, with what I would call and do call sham transactions that really proliferated and really undermined the tax system in the 1990s. So following Reagan, we had Bush 1 and then Clinton. Year by year, tax rates went back up. One by one, the tax benefits came in, and of course we reinstated the preference for capital gains. There were some important helpful changes mixed in. One I always think about is in Section 197, the first time a specific amortization was allowed for intangible assets, important part of the tax code. George W. Bush became president. His tax policy was described a little more eclectic, raising rates in 2001, lowering rates in 2001 to give the budget surplus back to the taxpayers, followed in 2003 by changes to reduce the tax burden, on capital, on capital gains to 15%, and dividends to 15%. But all along the way, we've had a lot of complexity added, and we've also seen the legislative process, and this is something we really shouldn't forget, morphed into a scramble to defeat the constraints designed to impose discipline on the process, starting with scrapping the pay-go rules and progressing to a greater and greater degree to manipulate and disguise the true cost of a tax change. My personal favorite is the offering the election. You guys know this was done 2 years ago. Offering the election to convert a normal IRA into a Roth IRA, not necessarily because people like Roth IRAs so much better, but because it then moved the tax collections from the conversion election within the budget window, thus moving future revenues in the tax system to the budget window and making the tax bill and helping pay for the tax bill at that time. The purpose today is to consider what we've come forward with some principles that we think ought to be part of any bipartisan tax reform. Just read them, the 5 principles: create a more transparent and stable tax code, promote tax savings through the tax code, rethink the value of tax expenditures, update the business income taxes, and implement environmentally motivated tax policies. So the panel will introduce in the order they're going to appear. Maya McGinnis with the New American Foundation and Director of the Fiscal Policy Program. Director of the Fiscal Policy Program at the New American Foundation. And President of the Committee for a Responsible Budget. Bob Carroll, who was Deputy Assistant Secretary for Tax Analysis at the Treasury Department. Bob is, all the resumes, by the way, are in the papers you picked up. But Bob is Executive Resident of the American University School of Public Affairs, co-founder, co-director of the University Center for Public Finance, and he's also Vice President for Economic Policy at the Tax Foundation. And then Diane Rogers is Chief Economist at the Concord Coaltion and was formerly Democrat staff, Economic Director at the Budget Committee and then the Ways and Means Committee. So let me stop there and then turn it over to Mike.
Great, thank you, Buck. Thanks to everyone for coming today, and I want to thank my colleagues because it's been a really interesting exercise to try to put together a bipartisan tax reform paper. And I think one of the things that we found, and most of you in the tax community know, is sort of hot button issue as taxes are. Most people, when it comes down to the basic economics and thinking about how tax policy works, see a lot of the same problems in the tax code and see a lot of at least the same principles for the kinds of solutions that there are. So this was, oddly enough, rather a painless exercise until last night at midnight when we were finishing up. But other than that, it was quite remarkable how I think we've come together both in principles and specific recommendations, all of which we'd like to see implemented, but also could work pieces of the different paper that we're talking about today could be implemented on an incremental basis. Again, just some of the principles that we thought of that sort of drove our work and then came to the major policy recommendations we came up with were that right now in the stimulus debate, we want to think about tax policy as helping to stimulate but not squandering resources unnecessarily. We want to broaden the tax base and lower rates, reduce economic distortions, encourage national saving, a clear goal given our dismal saving rates. Maybe not right now. We need to get through where we are in the economy first, but certainly the long-term goal. Make the system more transparent as a way of reducing avoidance, and then maintaining at least the progressivity of the tax system, and recognizing that efforts to alter that also need to work along with considerations for efficiency of the tax code. So I want to focus on the tax base and tax expenditures. Certainly, I think one of the principles that will always be part of tax policy is broaden the tax base and bring down the rates. That's what Senator Wyden was talking about. That's what we saw in 1986. That's certainly one of the guiding principles that we've come back to time and time again in digging through this paper. And basically, I think what that does is it builds a tax structure for you that no matter what you think are the ideal tax rates, level of revenue, level of progressivity, some of the hot button issues that people tend to disagree on, the better the structure, the more efficient the structure in terms of a broader base and lower rates, the more flexibility you have in raising your desired amount of revenues as efficiently as possible. So we made a whole lot of progress in that in 1986. Exactly what we focused on, broadening the base, lowering the rates. And since then, what have we seen? We have seen a tax expenditure bonanza, where we have just been kind of in a frantic race to put these tax expenditures back into the base. More now on the individual side than the corporate side, where they were before the '86 reforms. So you know, with every single year of tax legislation, you see new credits, you see new deductions, exemptions, exclusions, and certainly the result is exactly what makes the tax code so complex. Many people think it's having multiple rates that makes it so hard to navigate the tax code. That's really not the problem. It's the base. It's that it's very difficult to figure out what you're going to owe in taxes or what your rates are based on your saving habit, your educational choices, what you're doing with housing. You know, all sorts of crazy tax breaks in there. I read them all the time just for amusement, but tax credits for postal workers who had to work during inclement weather. You know, it's sort of like looking for pork in the stimulus bill. There's always a laugh line to be found there in the new tax expenditures that are passed each year. Right now we have over 200 tax expenditures. They're one of the fastest growing areas of the budget, keeping pace with entitlements. And in total, you're not supposed to add them because clearly if you reduce a tax expenditure, it alters behavior. So we don't really know what the total sum of them are. But if you added them and recognize that you're not supposed to, they would lead to a loss of $1 trillion in revenues for the government a year. Many years exceeding the cost of discretionary spending in the budget. They are a tremendous piece of the budget pie, but they fly under the radar. You don't see them broken out in the budget. You're not really aware of where they are and how many resources are allocated through the tax code. Obviously, there's a political rationale for using tax expenditures. What politician would prefer to say, I am going to give you health care, give you child care, give you educational help, and cut your taxes at the same time, rather than pointing out that this is really just a way of diverting resources, albeit through the tax code. But in many ways, these tax expenditures are spending programs run through the tax code. The problems that we've identified is that they're treated so differently than the rest of the budget. They do not go through nearly the same level of scrutiny when they're created. So when a tax cut is created, what do we look at? We look at how much it's going to cost and who it's going to help or hurt. But we don't even do the most basic sort of exercise of government, which is there a role for government in this? Should the government be doing this? If so, is this the most efficient way to do it? And once that tax expenditure is in the tax code, it doesn't have the committees of jurisdiction that go over and evaluate how it's working on a regular basis. We don't have oversight mechanisms, budget controls to limit these things. They're just like entitlements. They're on automatic pilot. Whoever qualifies for them gets the tax break, no matter the cost. We don't have kinds of spending caps to try to keep control on them. Once they're in the tax code, they're pretty much there to stay. Now, it's easy to talk about tax expenditures and people kind of nod and think they're not ideal. When you get to the specifics, it turns out they're some of the most beloved part of the budgets. I know this from trying to sort of give this speech at dinner parties with my friends. They kind of buy into it until I suggest that one of the biggest problems is, for instance, the home mortgage interest deduction. Suddenly, not so popular. And I've always thought in some ways that people understand the home mortgage interest deduction distorts the way we have investment policy, is regressive in nature, funnels money to not always the right places in the economy. That's kind of one of the litmus tests of tax policy. If people own up to that and the fact that we can look at how to reform something like the home mortgage interest deduction, I think you can tell they're pretty serious. For instance, the tax panel that the last president oversaw came out and talked about that. In many ways, people said that's what hurt the tax panel, but it certainly was a signal of the honesty of the work they did. Other big areas in the tax base that need to be looked at, like Senator Wyden mentioned, is the exclusion for employer-provided health care. We know that that subsidizes health care in a non-efficient and regressive manner. Many of the credits that are in the tax code certainly, or many of the tax breaks should be consolidated, streamlined, turned into credits rather than exemptions or deductions. if you want to increase their progressivity. And obviously, all these changes will have objections from the very people who are receiving those tax breaks. They are a great business for lobbyists, a great deal for recipients, and very desirable when you talk about them. They focus on things we all care about, but they're not the best way to do policy. So just to sum up, the kinds of things we think we need to change are increase the scrutiny and oversight of tax expenditures in the first part. They really have to be brought into the entire budget process. Budget concepts is very outdated, but it's how we do a lot of the scoring and evaluating different budget programs. And one of the things my organization is doing, we've just started with the Pew Foundation and Peterson Foundation, a very large budget process commission, which in large part will be focusing on concepts and the reform of concepts. Tax expenditures, how we score them, how we count changing them will be looked at. If you could say that cutting a tax expenditure was cutting spending instead of raising taxes, there'd be a lot more support for making those changes. Finally, certainly when you think about tax policy, there will always be differences in terms of the ideal amount of revenue, in terms of how progressive the tax code should be. But I would say, in thinking about this paper that we've come up with, I think each one of us would trade away some of our favorite sort of revenue levels, level of distributional effects, in order to make fundamental changes and improvements to the tax code, which is what we've tried to do here. And then just, I think the bright spot in this is, I am getting signals, and I think people are sort of seeing them, seeing articles about this. This administration is very serious about trying to take off some big chunks in bipartisan ways. There's no guarantee that it will be successful. There's a lot on the plate of all politicians right now. But given the fiscal challenges we have, the economic challenges we have, and the widespread belief that the tax code as it is certainly not close to anything anybody would have designed, I think there is a real opportunity to run with the kinds of ideas that could move bipartisan tax reform forward. So thanks, and I'm going to turn it over to Bob Carroll now.
Well, thanks, Maya, and I want to thank my other colleagues. I think what Maya said at the beginning is, you going into this, there are really two of us who are a little right of center, maybe a little more than right of center, two of us who are left of center, and getting involved in this project when you're starting, I had the sense, I think somebody else did, that we would really have more disagreement on some of the fundamental tax policy issues. And I think as we got into it, there, to my surprise at least, there wasn't as much disagreement as I thought there would be. It was actually smooth sailing, as Maya said, until we were sending her comments last night at 12 o'clock, and I don't think she appreciated that. But in any case, yeah, so we did agree on a lot. What I wanted to talk about is really kind of two issues. Really focusing, I want to focus on the need for a tax code to be more conducive to savings and also a business tax system. In some sense, you could think of this as if you were going down the road of base broadening, looking at tax expenditures very seriously, and rethinking some of them. What could you do with the revenue? As Senator Wyden said, you could lower tax rates across the board if you eliminate all the tax expenditures, completely broaden the tax base. You could lower all the rates by 34%, which is very, very substantial. But you could do other things as well. You could try to create a tax system that's more conducive to savings, and you could also revisit our business tax base. Fundamentally, when you think about tax policy, from an economist's point of view, I think about even without the challenges the nation's going to face down the road, just as a matter of policy, you want a tax system that's going to be as efficient as possible. It's going to raise $1 of revenue, take $1 of revenue out of the economy in the most efficient way possible. In the context of the challenges the nation faces, not only the kind of the immediate difficulty with deciding what to do about the expiration of the Bush tax cuts and the AMT, but entitlement reform. It's much more, I think, important now than it's been in the past to have a tax system that's very efficient, that we can squeeze as much out, much economic growth out of the tax system as possible to give us the best opportunity, best open chance to deal with the longer-term problems. I think what's very safe to say is our current tax system is really nothing close to efficient, nothing close to economically efficient. As Senator Wyden said, it distorts a number of very important decisions that businesses make, that individuals make, and many individuals and businesses find themselves making decisions around the tax system, to try to weave around the various provisions in the tax code, rather than making those decisions based on economic merit. So one way the tax system distorts that decision-making is it imposes a penalty on savings. And that's important because the penalty on savings reduces capital formation, reduces capital accumulation, and when labor has less capital to work with, it makes labor less productive. Labor productivity is one of the keys to rising living standards in the long term. So that lower level of capital formation, which is related to the tax penalty on savings, has the effect of lowering real wages, resulting in real wages and living standards that are lower than they would be otherwise without the penalty on savings. So we think that the penalty on savings needs to be reduced. And one way to approach that would be to shift our current income tax more towards a tax system that relies on taxing consumption. And that would be a way in which we could reduce the penalty on savings and create a more tax efficient, more efficient tax system. There are substantial benefits that could arise from such a shift. There's some estimates out there that suggest such a shift could increase the size of the economy, and the estimates are kind of across the board. They range from roughly 3% up to upwards of 9%, depending on how it's structured and the degree of the shift. There are also some very crucial issues if one shifted in a wholesale fashion from our current tax system to a consumption tax. Perhaps the biggest single one is one that Senator Wyden alluded to, is distributional. When you tax consumption rather than income, you tend to result in a tax system that's less progressive, more regressive. And we think that it's, such a shift should really only occur if it's distributionally neutral. That's the context in which it should be evaluated. And what's interesting is the tax panel, the presidential tax panel from 2005, provided some important guidance on evaluating the distributional effects on shifting to a consumption tax. They analyzed a particular type of consumption called the Bradford X tax, which I won't go into the details of it. We have a brief description of it in the paper, but it's a type of consumption tax that's very similar in structure to our current tax system. It has a business level tax and it has a tax on workers' compensation, but importantly, it has graduated rates at the individual level, which directly introduces progressivity. And the other thing that the tax panel found is, as kind of Maya alluded to, the current income tax base is so narrow relative to even a broad-based consumption tax base that one can retarget a lot of the tax expenditures that Maya was talking about in a way that brings a lot of progressivity into the tax, into a consumption tax type proposal. But absent a wholesale change, we think incremental changes would be very beneficial. We currently have an income tax that is an income tax in name only. It's really a hybrid of an income consumption tax. All of this tax-preferred savings accounts, accelerated depreciation are all elements of a consumption tax. About 35% of household financial assets in our current tax system receive consumption tax treatment. The effective tax rate on business investment is actually substantially lower than the 35% top corporate rate. The business investment is taxed at an effective marginal rate of about 25%. So that's basically reflecting a lot of the consumption tax treatment that's built into the depreciation schedules for investment in the current tax code, the accelerated depreciation. So one can change and expand those provisions to kind of move us further more along the lines of consumption tax to help promote savings. Another consideration that we think serious consideration should be given to perhaps thinking about VAT, a value-added tax, not to replace the current income tax, but to a small VAT whose revenues could be used to reduce the most harmful effects of the current income tax. So you could think of a small value-added tax on the order of 5 or 6% to replace the most economically harmful features of our current income tax, and also to address the regressivity issues that would arise when you have that. One of the advantages of introducing a small value-added tax to replace part of the current income tax is that a small value-added tax, a lot of the issues that arise when you have a wholesale change, transition being one of them, transition issues being one of them, are much smaller, much easier to deal with when you're introducing a small value. The next thing I want to turn to is another way in which our current tax system is inefficient. Our current tax system, our business tax system, I think what we're finding is very much lagging behind internationally. Going back to the 86 Act, one of the things the 86 Act did is it lowered the top corporate statutory tax rate at the federal level from 46 to 34%. What that did to the U.S. relative to other nations is put the U.S. in a position of having a very low statutory corporate tax rate relative to our major trading partners. All through the 1990s, all through this day, and continuing out, what we've seen is our major trading partners have reformed their business tax systems, lowering their corporate tax rate. And that's, we think, has raised some competitiveness issues for the United States. The changes in the statutory corporate income tax rate are really emblematic of deeper changes in our business tax system relative to other tax systems. We have a discussion in the paper on the trends on effective marginal tax rates, which take into account other features of business tax codes, such as the write-off of business investment, depreciation systems. And the changes in effective marginal tax rates, the U.S. versus other nations, shows pretty much the same pattern. Deep reductions abroad, and we've stayed at about the same level. So in that sense, we're falling behind. Another very important feature of our business tax system, and Buck made reference to this or alluded to this, so did Senator Wyden, is our business tax system also has very significant imbalances embedded in it. And having a more level playing field, a more uniform treatment of economic activity is kind of one of the main ways one can reduce the distorting effect of taxes, the way it interferes with household and business decisions. And then the two that I just wanted to very briefly mention is we have a double tax on corporate profits, which is a significant imbalance. We have very unequal treatment of debt, which should be very much appreciated in today's economic environment where we have the financial crisis. We have a very, very significant bias for debt finance, not only for home ownership with the home mortgage interest deduction, but with business investment. The effective marginal tax rate on investment that is debt finance is about 0 or negative. As I mentioned earlier, the effective marginal tax rate on business investment that is equity finance is about 25%. So what you see is this very large bias for debt finance projects, which results in companies being more leveraged because of the tax bias. And that is particularly problematic in periods of economic weakness when companies and households that are highly leveraged are much more susceptible to financial distress. And so that's a very big concern. So just taking a step back, there are lots of ways in which the tax system distorts decision-making, and we think that it's very important as we think about tax reform to think about the ways that we can have more uniform tax treatment of economic activity, as Maya said, kind of really rethinking some of the tax expenditures, trying to get to a place where we have a broader base, but also kind of trying to fundamentally address some of the major imbalances in the way we penalize savings and in our business tax. Then I'll turn it over to you. Thanks.
I'm going to talk about one of the ideas we have in the paper for how to stick with the principles we lay out in terms of base broadening, simplicity, and fairness, and transparency, and that's to pursue a more environmentally motivated tax system. And so one of the things we talk about is the idea of a carbon-based tax, and we call it a tax in the paper, although in the paper we also acknowledge that that's the sticking point in the policy, is that if you, there's a lot of discussion lately, there was a lot of progress made in the last Congress on carbon-based environmental policy, but it was done in the context of a permit system. So it wasn't discussed as a tax. But we discussed in the paper how, in a lot of ways, a market-based permits policy for the carbon content of fuels is actually very similar to a tax. It's a lot of semantics. The way it's not similar to a tax would be if you had a permit policy where you gave away the carbon permit, and therefore all the rents, the value of those, the market-based value of those permits would go to the private sector, so obviously that would not be like a tax. If you had a permit system where the permits were auctioned off and the government kept most of the revenue, the proceeds from those auctions, that would operate very much like a tax. In either case, what you're bringing to the market, to the economy, is a price. You're putting a price on using carbon-based fuels. And what we've witnessed over the past several years is economists from the right and the left, Democrats, Republicans, liberal and conservative, all coming together and very clearly, I think, stating that carbon-based tax policy would be a good idea. It's a good idea because it's one of those rare things that you can find that you could tax that would actually be to help improve incentives towards a more socially optimal allocation of resources in the economy. Most of the time, economists view taxes as a necessary evil. We have to raise the revenue to pay for public goods and services, and unfortunately, most of the things that we can observe in tax are things that are connected to productive behavior, productive activity. So we tax labor supply, we tax saving, we tax consumption, we tax things that contribute positively to economic well-being and economic welfare. There aren't that many things that we can find in our economy to tax that are bad things, that are therefore good to tax. And so a carbon policy is one of those things because carbon content is related to global warming. So the burning of fossil fuels or the use of any type of energy that has carbon in it will burn carbon dioxide, and that contributes to global warming. It's an environmental, social cost that economists are very aware of now. Unfortunately, economists are not very good yet at putting dollar values on the economic benefit that would accrue to us if we were able to reduce global warming. And yet, we argue that it is a good tax to consider because there are social benefits associated with reducing the consumption of carbon-based fossil fuels. And that we can do so in a way that would be consistent with the principles we laid out in the beginning of the paper, which is that we can do it in a way that broadens the base, keeps it simple, and is fair. Okay, and at the same time improves efficiency, improves incentives in terms of being consistent with social goals. Senator Wyden actually mentioned this. It was the last question he answered, and I found it interesting because it is certainly true that there are lots of inefficient ways you could do environmentally motivated tax policy. And I would argue, and I think my co-authors would agree, that we are looking to broaden the base, not narrow the base. There are certainly ways that you can turn the tax system into something that looks like it's more environmentally friendly, and yet does so by narrowing the base, by poking more holes in the tax base instead of broadening the base. So I give you examples. Instead of taxing environmentally harmful activities, if you subsidize environmentally friendly activities, that's an example of narrowing the base to promote environmental goals. And that's okay in terms of environmental policy, but in terms of tax policy, it's a very different thing. So what we are urging is for a type of tax reform that includes environmental goals in it, but that's also consistent with the goals of tax reform, not just environmental policy reform. And so I'm not a big fan personally, even though I'm a pro-environment kind of person, I'm not a big fan of avoiding taxing bad activities and just looking for the goodies in the tax system, wanting to give away the gifts to the environmentally friendly activity. I'm not a big fan of that because that costs money, that loses revenue, we're going to have to raise revenue elsewhere to pay for those subsidies in the tax code. So just like any other tax expenditure, that's the problem with tax expenditures, is that they really are just like direct spending. And yet the American public and a lot of politicians don't really see it that way. They think that tax expenditures are cutting taxes and therefore shrinking government, smaller government. And that is one thing that I actually think that attitude, that misconception about what a tax expenditure is, that we need to start to change that, because it's preventing us from broadening the base. Because broadening the base looks like raising taxes, it looks like bigger government. When the irony is, if we got rid of some of these tax expenditures, made the tax system more efficient, we wouldn't have to raise revenue elsewhere to pay for these subsidies through the tax code, and we'd actually be shrinking government, not expanding government. So there's a misconception there that I think has to change for this to actually work out in this grand bipartisan compromise. I'm not going to talk about carbon taxes anymore. I'm going to go on to a conclusion to sort of wrap this up. So it's in the paper. That's the last section of the paper in terms of a policy idea is to turn toward environmentally motivated tax policy, meaning broaden the base, not narrow the base. We are faced with, it might seem to some of you as an odd time to talk about tax reform and broadening the base, which sounds like raising taxes. And indeed, we're not really talking about raising revenues as a share of GDP right now. And in fact, you would not get agreement among us as to what the right level of revenues as a share of the economy is. So if you're thinking about asking that question, no, you're not going to get us to universally say it's 19, 20%, 18%, whatever, because we disagree on that. We do agree that the problem, even before the current economic and fiscal crisis, the problem has been a persistent mismatch of the level of revenues and the level of spending in the federal government. And that is not sustainable. So whatever Bob may say we have to lower spending to match revenues, and I may say we need to raise revenues to match spending. But either way you have it, there's a problem we have right now. The problem I see is that we are going to have a hard time cutting spending as a share of the economy, well, especially now, and for the foreseeable future, actually. There's obviously a lot of fiscal pressures on us that are going to make it difficult to do much to lower spending as a share of GDP. And at the same time, we have a revenue system in place. Our tax code is so woefully inadequate that we already are falling way short of the revenue we need to pay for the things we obviously want to do. And it's only going to get worse in the future. We just found out in CBO's last economic and budget outlook that was released in January that from September, their last forecast, to January, the worsening of the economic outlook alone, no legislative effect, just the economy, the economic factors, caused us to lose over $2 trillion in revenue over the next 10 years compared to what they were saying we would have in September. That's without any tax legislative changes. That's without any stimulus, any recovery plan. That's also assuming that the Bush tax cuts completely expire, by the way, at the end of 2010. Without any of those legislative factors that we're facing, we lost $2 trillion in revenue over 10 years. That's a lot of money. And that's with our current tax code in place, current law. So I think it tells us that our tax system is in crisis, that our revenue system is in crisis. You're used to hearing from the Concord Coaltion that the entitlement programs are in crisis, and yeah, I believe that they're in crisis. I actually think the tax system is something that has to be dealt with sooner, though, than entitlements, because we're in this crisis right now. I actually also think that the action-forcing event that's coming upon us is the end of 2010, when the Bush tax cuts expire. And we're going to have to do something about it. And we would all prefer that we don't wait until the last minute. What did Senator Wyden say? It's the last, 15 minutes? Yeah. I don't even want to wait for the last 15 days. But, we don't want to have to see us backed into a corner faced with the expiration of the Bush tax cuts, and then just at the last minute deciding randomly which pieces of the Bush tax cuts are going to be extended and which are going to go away. We think that's an unintelligent way to go about changing tax law. We think it's an action-forcing event, and that's why we should be thinking about tax reform now. It's already 2009, by the way, so it's not too soon to think about more carefully what are we going to do by the end of 2010. We actually have to think about it a little sooner than that, because January 1st, 2010, the estate tax goes to complete repeal, by the way. So I view it as something has to be decided about that before the end of 2009, not wait till it's gone. Once it's gone, it's very hard to get a tax back once it's gone. Same thing with tax cuts in general. Once a tax cut's in place, it's very hard to reverse it. And that is a political challenge, obviously, that we face. So ideally, you start from scratch, but everyone knows it's very difficult to start from scratch. Let me conclude that revenue neutral tax reform is really hard to do, let alone revenue gaining tax reform. And I think that we're headed for revenue gaining tax reform, because I think maybe even Bob would agree that it's very difficult to see how we can keep revenues as a share of GDP at 18 to 19% going forward. That doesn't seem like a sustainable plan. If it is a sustainable plan, we're going to be cutting spending pretty drastically in some of the entitlement programs, and all these ideas for reinvestment in our economy are going to have to go by the wayside, because there's just no way we're going to be able to cover the cost. We have to be willing to pay for what we want to do, and that includes tax expenditures. So, like I said, I think that public and political attitudes toward tax expenditures have to change. There has to be a recognition that these are tax cuts that actually increase the size of government. They don't decrease them. Bipartisan. Republicans need to start to realize that not all tax cuts are created equal. So I have a little lesson to both sides of the aisle. Republicans need to realize that not all tax cuts are great for the economy. So that's my little phrase there. In other words, a lot of the tax cuts that we're saying, or the holes in the tax base that we're talking about, are not good for the economy, okay? Because they lead to insufficient revenue, low national saving, and distortions, distorting economic behavior in ways that are not justified on the basis of social merit. Democrats need to realize that there are often much better ways to promote certain social policies that they want to promote, to assist low-income households, to help promote education, to help promote health care, help promote home ownership. There are often much better ways to do those things than doing it through the tax code. And so as a Democrat, I actually do not, I'm not a big fan of promoting social policy through the tax code when it makes more sense to do it on the spending side of the budget, when it makes more sense to do some of these programs more directly, whether it be at the state or federal, state, local, or federal level. And so I think it's our hope. We can lay out the principles and we all agree on these basic principles. Very easy to sort of get to this kind of agreement on paper, and we know that the challenge is political. We know that the challenge is to change public attitudes towards what is a tax cut. When is a tax cut good? When is it not so good? When is a tax cut free? When is it not free? That's a big problem that the public has, is tax cuts sound like money's given back to people. And we hope that President Obama, the Obama administration, and the new Congress are actually walking into this, all these new challenges with open eyes in terms of the need to reform the revenue system. Not just talk about all the great ideas for spending going forward, but the need to make sure we have a credible plan in place to be able to pay for it all. Thanks.
Congressman Ryan's going to be here shortly, so we'll have questions for the.
I'm Alan Gold from Results. Maybe Maya, you could address this. We've been fighting for a bigger child tax credit, bigger earned income tax credit, because this doesn't seem politically feasible to say have an expenditure or a child allowance like in other European countries. So how do you get around the political difficulty of getting appropriations or the regular authorization process to replace things like the EITC and the cities?
Well, I think everybody who wants to weigh in on that will. It's not at all clear that everybody would think we should do that. EITC is something that I think has proven to be a solid, effective, and bipartisan program. So I think that there is a lot of support for that. And I also think that either a credit in the tax code for members of the family or the standard deduction are things that generally hold a lot of support. Those are sort of the basic structures of the tax code that most people say is an acceptable starting point, and then it's the tax cuts, credits, deductions, exemptions after that that start to be more problematic. That said, while I happen to favor the EITC and a standard deduction that keeps up with inflation, your question is exactly, it illustrates what the problem can turn into, which is everybody thinks that their tax expenditure is the good one. And in some ways, shared sacrifice is going to have to be part of the mentality of tax reform. There is no way that we are going to fundamentally reform the tax code and keep in it everything that each person in this room, let alone this country, thinks is a good idea. Because the tax breaks that exist right now are things that most of us think are good: saving, healthcare, education. Oftentimes it's more a question of what the right design is. I do happen to think that when you're structuring your tax code to reflect your family size and your income level, progressive tax rates, and altering the base tax for the family size is appropriate, which is why I think EITC or deduction makes sense. But beyond that, I get a little bit less sympathetic. I don't know if that
I like the EITC too. I actually do like the EITC, and I think what I don't like seeing are just a bunch of really little, very specific, narrowly defined tax preferences that are often designed to promote social goals, but are often designed to give certain types of industries a tax break over others. I think there are ways to have a fair system and to have a system that encourages work. I actually like the EITC because of that, because there is that phase-in range that it does encourage work, and I'm not that worried, by the way, about the phase-out range. But I just think that there are a lot of there's a temptation to do, anytime you want to promote anything like buying an American car, right, or buying a home, to do it through the tax code, and education. We have so many different education tax preferences. It's just the way we go about it is often done so sort of randomly, and throw this in, throw that in, without looking at what is the goal. Is it a distributional goal? Is it actually to promote a certain type of behavior? And asking, is the tax expenditure or this mix of tax expenditures the best way to go about it? And we think that there isn't enough scrutiny of tax expenditures. It's not that they don't tend to be evaluated the way spending programs would, in terms of saying, this is the goal. Are we achieving it? What is the justification for this special tax preference? Are we achieving that goal? It doesn't seem like we ever look at tax expenditures with that same type of program scrutiny. And we think that we should, because we may be doing a lot of things in an inefficient way. There may be much better ways of doing it that don't poke holes in the tax base and require us to raise rates to cover the cost.
I think your question goes to a kind of a key issue in any tax reform discussion that's revenue neutral. You're always going to have winners and losers. Every conversation I've ever had on tax reform, certainly when I worked over at Treasury, where you spent largely 4 years working on tax reform, virtually every meeting, every discussion, I started out by saying revenue neutral tax reform is going to have winners and losers. And that always made it very, very difficult. People always came back and said, well, we need is a revenue neutral tax cut, which I've never quite figured out what that means. But it has, and I think what Maya said is kind of the path to revenue neutral tax reform is some notion of shared sacrifice. If you go back to the '86 Act, it was a broad base where a lot of people lost their preferences, their favorite thing, or they got less of it, but in exchange for that, they got lower rates. So I think here you do have to have some sense of shared sacrifice, and then some people have to have a sense for what they're going to get in exchange for that. Rates, are not terribly high relative to where they've been in the past, so one might need to think exactly what that would be. I would point out that, and Diane kind of mentioned this, that all the various holes we have in the tax code, the various provisions, do create a sense of unfairness. So I think a lot of people sit at their house at home thinking that their neighbor is taking undue advantage of their particular tax preferences and aren't paying their fair share. So the more special provisions that you have, I think there is this perception of unfairness. And Treasury and the CBO and the Joint Committee can produce distributional tables that show X, Y, and Z, but nevertheless, I think there is this sense of perceived unfairness. But then the last thing I wanted to say, or last two things I wanted to say, is when you think about tax reform and where the big moving pieces are, all the money is in the top 5 preferences. It's in the health exclusion. It's in the home mortgage preferences. It's in, depending on how you think about preferences, some people don't think of the savings provisions as preferences. I don't. Others on this panel would. And so you really have to tackle those 5 big. You have to tackle the 5 big preferences, each of which are political lightning rods, and makes it very difficult. So in a sense, I don't think that it's really politically possible to just attack one of them or change one of them. You kind of have to touch all of them, so there is this sense of shared sacrifice. And then on the issue of the hidden nature of some of the preferences, what's very interesting to me is that the single largest tax preference in the tax code is the exclusion for employer-provided health insurance. Senator Wyden spoke a great deal about it. If you went outside of this room, outside of the Beltway, most people would be surprised to learn that people in Washington think about it as a tax preference. It's really not thought of that way outside of the Beltway. And so that's, I think people need to, that's more of an educational issue perhaps, but that's an important aspect of the issue.
Yeah, please.
Yes, did you?
Sorry, we've got the problem with 2 people calling. How about you first and then?
My name is Mortimer Kaplan. I'm a former tax administrator, and I see the popularity of the earned income tax credit. But that is one of the largest abuse areas the IRS is facing. And it audits more of these low-income returns than some of the high-income returns. The question whether the IRS is the right person to be handling it. I want to ask you, Bob, about the word efficiency. What do you mean by that? How does that bump against simplicity and economic growth and so on?
Yeah, so what I mean by efficiency, economic efficiency, is what I mean is the manner in which the tax system, that decisions are being made for tax reasons, not based on their economic merit. And that shows up in the tax code in many different ways. One can think of it broadly as imbalances that exist in the tax code. One type of activity is taxed one way, and another activity is taxed another way. Taxpayers may shift their investments, may shift their resources, may consume more of an item that's tax favored rather than an item that's not tax favored. You see that, let's say, in the home mortgage. Not to talk about home mortgage. It's a tough issue to talk about. But there is a home mortgage deduction, and that probably encourages people to, when they buy a house, to take out larger loans than they would otherwise. They're more leveraged. It's not that we have anything against people borrowing money, but when they're doing it for a tax-motivated reason, then you wind up with a higher degree of leverage than would occur perhaps in the tax system. When you think about the double tax on corporate profits, it distorts a number of different decisions. Companies likely pay out less in dividends when dividends are taxed at a higher rate. There's likely less investment in the corporate sector relative to the non-corporate sector, because investment in the corporate sector is subject to the double tax. Investment in the non-corporate sector it is not. There's a tax penalty on savings built into our income tax. It's relieved to some extent through the very savings provisions. But nevertheless, we still have a significant tax penalty on savings.
I see the competition between your definition of efficiency and simplicity.
Oh, and then simplicity is well, there's competition and now. To the extent you have more uniform treatment of economic activity, if you taxed everything the same, there's complexity arises, I think, for two reasons. One, the provisions themselves are very complex, as Maya explained. It also arises because there are balances. When one type of income is taxed very differently than another type of income, people will try to perhaps earn their compensation in the untaxed or lightly taxed form. You might see that, let's say, in the treatment of certain types of stock options. People will try to get more of their compensation in incentive stock options and non-qualified options because it's a less tax costly way to receive compensation. You see that in healthcare. If I'm receiving compensation, I would much rather receive $1 of that compensation in employer-provided health insurance as opposed to wages, because I'm only going to pay tax for that compensation. I'm going to, if I receive it as wages, I have to pay 30 cents on the dollar on average. If I receive it as health care, I don't have to pay any tax.
Yeah, I just to quickly weigh in, I've always thought through the question of weighing the tensions that exist in all of policymaking and tax policy in general. One of the most interesting parts of trying to go at this, because if you pick just one of the principles and ignore the tensions it has with the others, obviously it seems very easy to achieve that goal. One clear tension in tax policy that always exists is that between quote-unquote fairness, whatever that means to different people, and efficiency. And I think it was actually in thinking about that tension that we came up strongly favoring a form of a progressive consumption tax. So on that note, I would just like to welcome Senator Domenici, who's just joined us in this room, who is the author of the famed Nunn-Domenici tax policy, something that I think is the backbone of what we're talking about. It won't put you on the spot, but if you care to make any remarks, we would certainly love to hear from you. And actually, to welcome all of you, it's so nice to have such a quality audience. One of the problems I sometimes worry about when we offer food is that we get people who care less about the policy and more about the data shifts. But it's we really appreciate that these are sort of leaders in the tax field who are here.
And let me add, and that's for someone you do not know, but the last question was asked by Martin McCaffrey.
Yeah.
He knows a thing or two about the administration of the tax system. He was a fine advisor and lawyer now, and in the 1960s he was commissioner for revenue. A little simpler code from those days, but it was important.
Yes.
Yes. Frank Disco, the American Academy of Actuaries. And you've all talked about the principle of broadening the base, but if we do switch from an income tax or an income consumption hybrid tax, if you will, to a more pure consumption tax, isn't that aspect of it a narrowing of the base? And there might be reasons to do it, but you pay a price for that in terms of needing to have higher rates otherwise.
Yeah, I think what's interesting about that is even though the base is more narrow and initially you would have a higher tax rate, it's a more efficient system because you're not penalizing savings and you're not reducing the level of capital accumulation that would occur under the current system, let's say. And it's the capital accumulation when you give labor workers more capital to work with, they'll be more productive, and it's labor productivity that is kind of the key to rising living standards and rising real wages. Kind of the story I kind of go through just to put some texture on that is, you look at the period, I think it's from 1973 to 1995, labor productivity in the nation averaged about 1.4%. In the late 90s and early part of this decade, it averaged in the low 3s. When the labor productivity averages 1.4%, it takes about 50 years for living standards to double. If you could get labor productivity to twice that, keep it in the high 2s on average, then living standards would double not in 50 years, but in 25 years. So that's kind of the benefit of that. Some people don't think of the tax, don't think of the tax so-called preferences on savings as preferences at all, because they think of the tax system more from a consumption tax perspective than an income tax perspective. So in tax policy discussions, it's really a very significant debate of whether you think about the savings preferences and investment preferences as preferences at all. So hopefully that addressed your question.
Bob, let me mention, I know you, but one of the big tensions when you talk about moving much more strongly to a consumption tax is what I call the transition rule. And the easiest way is the auto worker who saved after-tax savings all his life, moves to Florida, finds the consumption tax put in effect. He's going to be taxed again when he spends his previous tax savings. He's not going to get the joke. And so you have to deal with that problem. I know there are ways to deal with it, but it's difficult.
And the other issue would be progressivity. That's the other big, that's really the big Achilles heel of consumption taxes, the progressivity issue. The progressive consumption tax in the form of, let's say, the Bradford X tax, where it's bifurcated. You have a cash flow tax on businesses with a deduction for wages. You tax wages or compensation at the household level, and you have impose a progressive rate structure on compensation that directly introduces progressivity. You can also introduce more progressivity by refocusing the tax preferences. What the tax panel found in 2005 is a progressive consumption tax can be designed to exactly duplicate the distribution of the tax burden that we have today. It still leaves the Warren Buffett issue that Senator Wyden alluded to, where someone like Warren Buffett, who receives most of his income in the form of the return to saving and investment, would on paper pay no tax. He might pay a lump sum tax on the existing stock of his wealth, a trick of moving to a consumption tax. Usually economists think of it as imposing a lump sum tax on existing capital, which carries with it some of the transition issues that Buck alluded to. I would say Warren Buffett would in fact pay a fair amount of tax. Warren Buffett in particular would pay a fair amount of tax as if we moved in wholesale fashion to a consumption tax. But anyway, the distributional issues I think can be addressed, and I think some of the panel's work demonstrated that.
I think one of the other pieces is just that this is a paper that has lots of different tax pieces to it, and we talked about you could adopt it in a piecemeal fashion or all the parts as kind of fundamental tax reform at once. But there's always going to be a number of different moving levers in the tax code, and that means depending on how you try to talk about transitioning to and adopting a consumption tax, and again, I do favor a Bradford X or a non-Domenici or a progressive consumption tax. There are also other tools in the tax code that you can use to achieve your distributional goals. So you don't want to sort of stop at some tax, perhaps an energy tax, and say we don't want to move in that direction because it's distributionally not what we might favor when there are other places in the tax code that you can achieve that. I've always thought that one really interesting exercise would actually be to start with the top line question of what's your distributional preference? Figure out how much, I mean, this is one of those ideas that's kind of divided in right and left. People on the right tend to say the tax code is too progressive. People on the left tend to say it's not progressive enough. Most of them actually don't know what the current distributional tables are, but they'll probably stick in those two boxes no matter what. And I always thought, just for the sake of exercise, we really need to start with that question of who do you want, given income distribution in this country, to pay how much in taxes, and then work back from there to create the most efficient tax code. Maybe that's our next paper.
I'd just add to that. Looking at the current distribution of the tax burden, that the current tax system is in fact progressive, it's a matter of degree. Then the observation ought to be also that a lot of redistribution occurs on the spending side. That's something that's not taken into account, factored into really any policy discussions. The government is really in the business of doing things the market wouldn't do otherwise, doing some things the market does do, should do, and perhaps the government shouldn't do, and redistributing a lot of income, addressing various market failures. Well, redistribution is a big part of what occurs on the spending side.
We are momentarily going to turn this over to our guest, Congressman Ryan. Before we do that, I wondered if Senator Domenici, I could convince you to give a couple remarks.
Well, first of all, yes, indeed, I will, and it will be brief. But let me say, I'm very pleased that you have such a big crowd and that you see the diversity of politicians and political leaders that are once again seriously interested in the subject matter. The fact that you now have various foundations that are more or less powerful in terms of available resources that work together in an effort to move ahead with business and truly salutary. I would just like to make an observation as one who was either chairman or ranking member of the Budget Committee of the Senate for 26 years. We did, in fact, get two balanced budgets. We did not my time as chairman. And side was convinced by a group of American businessmen to join with Sam Nunn and produce a new tax code. Somebody paid mightily for the work that went into it, and it is a magnificent work, the USA tax. We did not just postulate it, but because we had so many questions, somebody was willing to pay, and we have an entire tax code, corporate and individual, that is built around not taxing savings, taxing only what you spend. That's unlimited savings accounts, which is the name of the code, we call it USA. It's still there, it's in its entirety available to be looked at, and there's no doubt in my mind that some of the basic concepts that are within it, if not everywhere, will be certainly looked at for corporate and business tax of the future. Tax code USA for business and corporations in America is an absolute marvel. We've done it from the beginning, wherein they wouldn't have to keep their books on depreciation and all of that if they did it the way the non-diminutive USA does it. That was fantastic freedom for American business in terms of tax simplicity versus tax complications for them beyond belief. I came today wearing a new bonnet because I'm no longer a senator. It's 6 weeks I'm in retirement. That means I'm a really retired person. You know me from years ago, and I was going to tell you how good you look, but I didn't want to risk that you would comment on my appearance. but I did come as my new title is a senior fellow with bipartisan policy. Where's my check? My president. There he is. Jason DeVay is the one who started this operation, and I'm very pleased that they asked me to be a fellow. So you'll hear from me. I am now looking at what I like, even though I can't say it's the love of my life, because who could be in love with deficits? But that's been my life, so I got back to it, and I'm now very, very immersed in what are we doing to the deficit. Where is America going to be when we're finished with all the stimulus and everything else? How much are we going to owe the world, and how are we going to be able to pay? And I submit to you, I hate to, but when we finally get all that done and we look at how much we're going to have to pay every year to liquidate our debt, and who's going to own it, and if somebody like China is going to own a big part of it, are they going to be fair or are they going to be unfair for us? I don't know any answers to those, but I can tell you how we pay our debt might be more front and center major American issue than yours. Because this is imminent. They're going to look at it in 2 years. We're going to be looking out there and saying, my God, how do we pay this debt? That's my prediction. I already have some numbers. It's rather stark. It doesn't mean we should not have done what we did. It just means all of it is on credit. And we don't seem to want to remember that. Every penny that we are using, and have been using for the last 2 years, to try to get out of a debt where we already have a operational budget deficit of 1.3 to 1.5 trillion, and then all this other stuff, how you going to pay it is going to be, this administration is going to have to tell us what it looks like. What do you assume the interest rates are going to be? I guarantee you, right now it looks beautiful. The interest rate's 0.5%. There's nobody else attracting the money but America. And they're not giving it to us because we're terrific. It's because we look secure. We're not a good business country yet, but we look secure as compared with everybody else. So money's awash, but it might not be. And if it goes from 0.5% to 4.5%, the numbers that they're projecting will be, you all are good at it, you know what will happen, it'll be a monster. And so that's my little mission, and it's a fun one. I do other things there with Jason and his people. And I'm delighted to spend my time there. I hope I can do that for a number of years, and I hope to run into you again as a brother. Exciting days. You You sound exactly the same. Which brother is which?
I have a twin brother that looks, he's a very handsome guy. We both served, I will say, we both served at different times as Assistant Secretary for Tax Policy. So that's what the treatment. I've appeared before the chairman of the numerous times.
I want to thank you for recognizing me as a representative. Good luck.
Thank you.
Thank you. Congressman Ron.
If I could, I'll just make one comment as we transition to Paul Ryan, who one of the reasons I think we took on this tax paper is also because we care so much about the fiscal issues. And anybody who knows Congressman Paul Ryan, who's ranking member on budget, knows that this is somebody who cares deeply and is highly involved with budget reform, tax policy, and entitlements. Yeah, please, I'm just about to sing your praises. Do you want to listen? No, I'm just kidding. And one of the sort of really remarkable things about Congressman Ryan is that every issue that he gets involved in, all of these fiscal issues, he not only sort of elevates the issue, he takes it head on and he comes out with specific ideas. And that's one of the things that I and many people have long admired about how he approaches policy issues. So we're looking forward to his comments today on tax policy.
Some people say taking him head on, some people say flying into a cliff. That's the other way. Yeah, Tim.
Please,
Do you want me to
please,
get?
yes, would you please?
We should have gotten you a bigger room. So first of all,
We do.
I just want to say, Senator Domenici, thank you for coming over to what we are told the Senate refers to as the low rent district. Over to the House side. It's a pleasure to have you here. I wish we could have gotten you a bigger room. This is a budget committee room, and budget committee we have small things around here. Let me be brief. You had Ron speak to you earlier, right? And then you did this panel. I'll just give you the tax reform bill I put out, which was inspired by Ron Domenici, inspired by Paul Ryan, inspired by a lot of other trailblazers in the tax reform area. And what I was seeking to do when I wrote this tax reform plan, which is part of my broader entitlement plan, I refer to as Roadmap for America's Future. You can go to www.americanroadmap.com or .org if you'd like to get the actual specifics. It's a plan that works on entitlements, rewrites the entitlement programs to make them solvent, healthcare as well, but I'll simply stick to the tax system. This was not a tax plan I was writing to hopefully get an award from the Cato Institute. As much as I probably would prefer to do that. This was, yeah, right. This is a tax plan I wrote to try and actually get done, to try and make it actually doable, to try and make it so that people could come together and pass. Not something that works perfectly well in somebody's theoretical mind like my own, but actually doable. So it starts on the individual side with a two-tier flat tax system. A 10% rate and a 25% rate, a progressive system. So we maintain not only, even in a pure flat tax you can have progressivity, but in the rate structure we keep progressivity. So the way we decided to do it was a choice. Instead of sitting in the Ways and Means Committee, which is my other committee, and I've been on that committee for about 10 years now, picking winners and losers in the tax code and how things affect them, let individuals choose when they want to convert over to a dramatically simpler system. Give people a choice. The current thing we have right now, or choose to go over. They got 10 years to make a decision, and there are some other things I can go into details in Q&A. The point is they can go over to a cleaner system, 10% on the first $100,000, 25% rate on everything above that. Generous personal exemptions, $12,500 for an individual, $25,000 for a family, $3,500 for the personal exemption. A family of four earning $39,000 would not pay taxes until up and after that amount, and that's when the rates would then kick in. No tax on capital, no multiple layers of taxation, no tax on capital gains, no tax on dividends, no tax on death, tax income once at its source and never again. On the business side, just like Paul Ryan and others do it a slightly different way, we proposed a credit method of VAT. Business consumption tax is what I call it. Now, if you swap out the entire corporate income taxes, which is what we propose to do, and replace it and raise the same amount of revenue roughly, the rate is 8.5%. There's something interesting about that. If you look at all our competitors in the first world, their consumption tax rates are somewhere in the teens, 14, 16, 18%. Ours would be 8.5%. This accommodates also a 10-year transition period for firms to organize their affairs and transition their credits to carry over for 10 years. Now, what does this do? It does a couple of things. Number one, it's an economically dramatically efficient system. It's a territorial, not a worldwide system. It's a system in which all firms get to have immediate expensing and immediate write-off of business equipment capital purchases. It's a system that's border adjustable, where the tax is removed off of all exports and placed upon all imports. This is essentially what our competitors do to us as well. And so it's a system that is very efficient. There's no EBITDA. There's no tax drag on the balance sheet of firms. It makes U.S. firms so much more globally competitive. I would basically argue that the moment is here and now for bipartisan tax reform, and that is this. There are two reasons. Number one, the whole code blows up in about 2 years anyway. I won't go into all those points. I think people know that. The thing blows up anyway. Number two, this is the 21st century, not the 20th century. America can't just take its leadership role in the global economy for granted. We have new kinds of foreign competition. We like it or not, we are in the era of globalization. We have no choice but to not just thrive and survive it, but to get out and lead it. And so by switching to a tax system where America becomes the haven for capital formation, where America becomes the place where companies want to have as their domicile, as their destination. Instead of Barbados and Ireland, let's make it America. So our firms are much more prosperous by being American firms, by giving people incentives, by showing that businesses, their effective tax rate on investment is essentially zero under a system like this. This helps put America in the lead in tax competition. America is way in the back of the pack in tax competition. Our corporate income tax rate statutorily is the second highest in the industrialized world. We are failing and falling in tax competition. We started around the tax competition in '86. Many countries responded. Now we're losing. This is a way for us to get back to where we are and to raise the kinds of revenues that we historically have raised for the federal government, but in a far more efficient way. We ran distribution tables. We had people at OTA, the last administration, help us do this, and it was essentially distributionally neutral, so that the tax burden is borne. You can never get these things perfect, but the idea here is to have a distribution that is fair, that is bipartisan, that attracts votes from both sides of the aisle, and that's why we stuck with a progressive income tax system on the individual side. Your paper, you mentioned carbon. I'm not a big fan of carbon taxes, nor am I a big fan of cap and trade. I think that's even worse from an economic standpoint. But this would be the cleanest way to do it. If you're going to do this, I prefer a subtraction method personally. I think it's just cleaner from a pragmatic standpoint. Economically, it's probably a wash, I assume. But if you did it, you'd want to do a subtraction method tax, and you could take this tax system, which replaces the corporate income tax system, and embed the carbon tax within it, so that you have a base take rate, I don't know, 3 or 4%, and then you have it on carbon intensity. And that way, because we know the Chinese and the Indians are not going to do cap and trade regimes, this way you're taxing their carbon as it comes over. This way, you're putting the right price signals into the economy based on carbon intensity, and you're giving people like me, a conservative, tax reform. You're giving us a better system to make America, businesses and jobs and the economy more competitive. Those of us who are big critics of cap and trade largely point to the cost-benefit analysis. The cost far outweighs the benefit of doing such a regime from an economic standpoint. I come from Wisconsin, the manufacturing rust belt of America. We're going to lose a lot of manufacturing jobs in my part of the country if we do that. So why don't we have a system, if our whole interest is to send price signals on carbon, that leaves the money in the economy, doesn't bring up to Washington to create a pork fest, and actually makes our companies more competitive, helps manufacturing not only survive, but actually thrive and be more competitive in the global economy. And so you can take these things and you can put these carbon price signals in them if that's what Congress chooses to do. And the simple point that I want to make, and I'm glad he had Ron Wyden, because he's a very serious guy who I think is a person who's shown a lot of leadership in these areas. I think we can have a much better tax system that raises the money we need for the federal government, that does so in what many people would observe as an equitable way, and does it to make America lead in the 21st century so that we can have a more prosperous America. And I'll just leave it at that. Thank you.
Any other couple questions? That would be great. Please.
Sure.
Your individual tax of choice sounds very much like Russell Long. I used to call it the long short form. But his plan called for making an election in 1 year, but not getting out of that election for 5 years.
Yeah.
Unless it was bankruptcy or death. Just, you couldn't play games.
Right, exactly. Very important point. I do the same. I don't do it 1 year. I do this. You can't hopscotch back and forth because then you can break the system. So under my regime, you got 10 years to make a decision. Once you make a decision, you only have one do-over, and then if you have a life-changing event that changes your status, you get married or something like that, you can change your status. Give 10 years of people who maybe are immersed in tax expenditures to make their decision and unwind their affairs, but don't let people bounce back and forth. I think that's very important. The other reason I decided to do this choice thing, and some people think it's gimmicky, this is how you get it passed. I've been on the Ways and Means Committee, on the tax subcommittee there for 6 or 7 years on select revenue. The tax expenditure lobby is so strong and so powerful and so motivated that the general public, they think that tax reform is neat, sounds good. They don't spend every waking hour trying to fight for it. The tax expenditure lobby, however, does. And so I believe it is an easier path to actually get this done through Congress, because all of the tax expenditure lobby that come in and say, oh, don't get rid of our pet thing. Don't make sure you erect this barrier to entry from my competitors so that I have preferred status in the tax code. The answer that any congressman who's not really a big tax reformer can say, look, I'm not doing away with your tax expenditure. I'm not doing away with your thing. I'm going to let my constituent decide if they want it or not. And so to me, from just a practical legislative standpoint, the choice regime has a lot of beauty to it. Beauty because you let the constituent decide what's right for them, and you're not wholesale pulling something up by the roots and then having the dislocations that might occur with them. Now, how many people are here from the tax expenditure lobby? They hear me say something.
If I may.
Sure.
I'm Jesse Levine. My company's build heavy machinery in the Midwest, so nice to see. Nice to be here.
What do you build?
We build metal forming automation equipment, which
Like CNC?
Well, no, we use CNCs,
okay.
But we make the machinery that moves the metal through presses.
Okay.
So it starts with coil on one end and ends up the entire exterior.
You sell to Scott Forge?
We sell to people like that.
Yeah.
But one of the things that I'm curious about is you mentioned sort of the arbitrage that in '86 we became tax leader,
right.
And then other industrialized nations basically leapfrogged us. What happens, assuming you can get this through? What do you think? How do you continue to maintain the U.S. because we are behind in terms of capital formation? So, sort of anticipating success in this round, which I realize is huge. How does the U.S. continue to be the capital formation leader at a time of substantial deficits?
I think there's nothing better than to set off a new run of tax competition going in the right direction. That would be phenomenal if we did that. Number one. Number two, the way to do it is, look, I get rid of the entire corporate income tax, replace it with a single-digit consumption tax for manufacturers, which is the heart and soul of where I come from. Immediate expensing, voter adjustability, and the tax rate itself is less than half of what most of your competitors' countries charge their firms. And so the rate, I think, matters. So let's say we start with the 8.5% rate, which accommodates the transition that I propose. You got to keep that rate down. And that's where Congress, that's where, you have to have budget reform. You have to focus on the spending side of our ledger book. And you have to have, I'm a believer in artificial budget constraints. You have to rewrite the way the federal budget process works on spending and taxing to prevent the pressure to just keep sneaking up tax rates and then make us less competitive. So, to me, the way to keep us in the lead is, number one, give us a rate that replaces the revenue we get from corporations, which actually we rely on these revenues less so than our competitors do. That's an advantage we have. It gives us a chance of swapping out a better system that taxes so much less, and keep the rate down. That's the key, is keep the rate down, keep the rate down. And the only way to do that, in my personal opinion, are artificial budget constraints, and then fix the entitlements, which is driving this stuff.
Any other questions? Well, thank you, Congressman Ryan.
Thank all of you.